Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello dear friends, welcome to the revision session of the first chapter of CA Final AFM. Now this chapter is called Financial Policy and Corporate Strategy. Now some of you might know the importance of this chapter if you have been a student of CA Final SFM. Almost always we used to get a question on this in old syllabus SFM, and the best part is even with a reduced weightage for theory, there have been questions on this particular chapter, on this particular topic in May and November 24. So please remember, this is still an important topic or important theory topic. Some of you might want to study this chapter right at the beginning, some of you might not want to do all theory together. Either ways it is fine, doesn't matter, but please ensure you study this chapter. Okay, now I have tried to cover this chapter trying to build some kind of mnemonics and make it simple for you to understand and remember a bit of stuff, because this is a revision session, right? So let us dive right into it and start the revision for first chapter, Financial Policy and Corporate Strategy for CA Final AFM. Now most of you know me. If you don't know me, this is my background. I'm a CA, CFA and ISB Hyderabad graduate. I co-founder and CEO of IndigoLearn. I teach CA Final AFM. I teach level 1 and level 2 of CFA. Taught quite a few students. I'm passionate about financial markets and economics, and these are the organizations where I worked, and these are my qualification places where I've studied. Now coming right into the first topic, okay, or rather the first aspect in this particular chapter, and this was added in AFM. By the way, if you're an old syllabus SFM student, please remember this is a question that is this, or rather this is a subtopic that is added in AFM. There are also some more topics that are added after November 24 exams. I will tell you what those are. Okay, small topics, and there is a practical question also. This particular topic, they have added one practical element. Anyway, we will discuss that when we come to it. First topic that they have added is role of CFO in value creation. So traditionally the CFO, if you look at probably 90s, 80s or 2000s also, or even 2000 till 2020, the role of CFO was very, very different from what the role it is today. Okay, post 2020 there's been a dramatic change. In fact, post 2015 itself there's been a dramatic change. The change is, and not only in India, this is not from an Indian context, from a global perspective itself, there's been a substantial change in the way CFO's roles have changed. So if you look at a traditional role, right, CFO is focused on whether the organization is following ethics, whether they're following the guidelines. The more focus was on corporate governance, on controls, whether all controls are in place, whether, as I said, governance and all compliances, whether there are enough, whatever compliances have been set up, that is, your SEBI, if it's a listed entity, or ROC or MCA plus income tax plus GST, a lot of time used to go on that, and of course audit also. Okay, there's a lot of work on financial reporting. Even though large companies used to have somebody called as a financial controller, the CFO still had a lot of weight and focus on the annual report and quarterly results and all of that, right? Along with doing all of this, the goal was to ensure there is a focus on wealth maximization. That is, the company should grow, the shareholder should, the EPS should grow, or EBITDA should grow, and share price should grow, and the shareholder wealth should maximize. That was largely the focus. But over the last probably decade or two, substantial things have changed. Now, today's CFO, right, not only does all of this plus this today's CFO, they have to also get involved in strategic decision making and operating decisions. When you say strategic decision making, think of things like M&A, think of hiving off businesses, acquiring new businesses, exploring new business lines, probably investing in businesses that have binary success or failure, that is either 1 or 0, things like startup, right? So lot more focus is on strategic decision making rather than focusing just on books. Okay, then on operational decisions, that is, you are very, very closely involved with the operating decisions. When I say operating decisions, not necessarily accounting and finance, I am referring to operating decisions like your supply chain management, your procurement, then you have your IT infrastructure, then you have your marketing related stuff, then you have your production related stuff. So you are very, very closely involved with non-financial or non-accounting related activities, but that are operating activities, very, very essential for business. and you're part of the strategic decision making. So you work along with the CEO in a lot of these other aspects where not only financial elements or accounting elements are involved, a lot of non-financial and non-accounting elements are involved, right? Because if you look at any of the supply chain, marketing and all of that, the CFO may not know marketing, but the company is spending money on marketing. So you have to get commensurate return. CFO may not know supply chain, but then one kind of a supply chain methodology, especially post implementation of GST, post COVID and all of that, some kind of supply chain routes may be costly, but they may reduce risk. Other kind of supply chain routes may be very cheap, but then they may be exposing the company to a lot of risk. So you may have different kinds of perspectives like that, right? The entire risk management is a major activity. Earlier, they used to focus only on accounting aspects. Now you also have to take up a very active role in risk management. So if you look at it, what is it that a modern day CFO does? A modern day CFO focuses on value creation. Please note, this is a very important word, value creation. They oversee risk management, they establish financial viability of a supply chain, they evaluate M&A, they explore sustainability financing. This is ESG. Okay, a modern day CFO does ESG, R, supply chain and M&A. So MSRE. A modern day CFO does this. What is this MSRE? M&A, M is M&A, S is your supply chain, R is risk management, E is ESG. What happens in each of these? In M&A, you're supposed to evaluate projects. You're supposed to go through each of the projects and see whether we are acquiring it for the right price. Are we acquiring it for the right reason? Are we merging for the right reason? Because of that, are we getting enough value? Is the value correct, incorrect? What is going to happen? You're supposed to evaluate all of that. If you look at this supply chain, as I mentioned, your focus is a lot more on trying to figure out whether the right supply chain routes are available, whether this is a viable one or non-viable one. Or risk management, you have to figure out whether the organization is more exposed to more risk or the risk is reducing. You have to work with the committees of the board or the board itself to figure out what is the risk management framework that exists in the organization and then take appropriate decisions. And finally, you also have to explore this ESG, which is a new buzzword in the last 5 to 10 years. Environment, sustainability and governance, because today's investors demand that the corporations or the entities be ESG active, proactive. That is, they take care of the environment, they have strong governance procedures in place, and they are operate in a very, very sustainable manner. And ESG financing is a huge area of financing because a lot of investors choose to invest only in companies that have a good ESG score. If not, they in fact resist from investing in companies which have a bad ESG score. Think of, let's say a power plant that is heavily polluting. They may not invest in it. But a power plant that is operating very efficiently, they may actually choose to invest in such kind of thing, which is why a lot of solar plants are getting financing at a very, very attractive rate. So these are the things that a modern day CFO focuses on. Rather, compared to a traditional CFO whose goal was more on wealth maximization and compliances and ethics and all of that, a modern day CFO not only does all of those but focuses on all these other aspects also. Okay, now this is a very important topic because this has been added in AFM. Okay, so I expect a question on this very soon. Now, what are the fundamentals of business? There are 3 fundamentals of business. That is, you need to have a very, very clear strategy. Strategy, please note, is a long-term word, and strategy is more concerned with application of the funds that are raised. And financial resources. Financial resources is basically about raising enough resources to meet your strategic requirements. So it is basically about the sources of fund side of the balance sheet, whereas your strategy or corporate strategy is more about the application of fund side of the balance sheet. And for doing all of this, you need to have right management, that is right talent or right skills. So these 3 put together, that is a clear strategy, a good proper corporate strategy, well laid out, well thought through, well discussed, well intentioned, well created, with adequate financial resources to meet the strategic objectives by using the right team, talent or management. It will lead to a successful business venture. So these 3 are fundamentals. These 3, a clear strategy, financial resources and right management or talent. These are the 3 essential elements of a business, or 3 fundamental elements of a business. You can call it either way. Then if you look at this word called SFM, which stands for strategic financial management, the name of this course in old syllabus, strategic financial management. The word is not gone just because they've changed the chapter name, okay? Strategic financial management, what do we mean by strategic financial management or SFM? What we mean is, it is an integrated approach. It is an integrated approach to applying financial management techniques. It's an integrated approach to applying financial management techniques to achieve decision makers' objectives. So what we are saying is, there is a strategy. That strategy says that we have to grow by this much, we have to achieve this much sales, we have to achieve this much market cap, we have to achieve this much wealth maximization, whatever. Those goals have to be achieved. Now, in order to achieve these goals, you apply the financial management techniques of raising money, you invest money, evaluate projects, then continuously monitor the projects. Then if something is working, then probably if possible see if more invest can be made. If something is not working, see if disposal has to be made. You do all these techniques basically of the financial management. You do that in an integrated manner in order to achieve the original objectives. That aspect, that process is known as strategic financial management. That entire process of applying an integrated approach by applying financial management techniques to achieve the goals or objectives of a decision maker is known as strategic financial management. So if you look at strategic financial management, right, there are certain aspects that you need to remember. It is linked with accounting but with a different focus. What do we mean here? See, accounting is a backward looking function. That is, it is about recording, it is about bookkeeping. What happened, how much did we purchase, what did we do, everything is in the past. But finance is something all about the future. What is going to happen in the future? Will this project give me money? Will this project generate returns? Will this project go bust? Will this project add value to me as an organization? So you are trying to marry, you are trying to combine the backward looking function of accounting with the forward looking financial management. So you are combining backward looking accounting with forward looking finance. That is what you do when you are basically using this word called strategic financial management. The financial management is done with a strategic focus where you combine the accounting, backward looking accounting function with the forward looking finance function, and it involves allocation of scarce capital resources. So because there is wealth management is the focus and you have to achieve certain objectives and all of that, to achieve these objectives you have financial resources which are limited in size. You don't have unlimited money. Okay, so you have limited money. With that limited money, what kind of projects do you undertake? With that scarce resources of cash, what kind of projects do you undertake? If let's say I have 1,000 crores, with that 1,000, how do I make the maximum bang for the buck? BANG, bang for the buck, BUCK, buck. Okay, and the focus of doing all of this is on strategies to maximize the organization market value, which is what I said, right? The increased shareholder wealth, that is, focus is on maximizing organization's market value, right? And it includes implementation and monitoring of the chosen strategy. It is not just, I have a strategy, I have some money, I will deploy the money, and then lo and behold, everything will happen. No, it doesn't happen like that. After you deploy, you have to monitor the projects. You have to look at take the feedback from ground level, from at the project level, understand what is happening. If required, take hard decisions and then ensure that the project succeeds very well. It is not just about making an investment decision, but the investment decision also involves continuous follow-up, feedback, modification and learnings, and then generate returns, using those returns to reinvest in something else. So this is what encompasses strategic financial management. Fair enough? Now, let us move to the next part. What are the functions of SFM? That is, functions of SFM are investment and financing decisions. SFM, part of the corporate strategic plan, combines investing and financing decisions to attain overall objectives. That is, the strategic financial management involves both the investing part as well as financing part. Investing is your strategy part, right? Financing is your financing part, the way you raise resources, right, for attaining overall objectives. Now you see here again there is another mnemonic called SSMCA. What is SSMCA? Search for investment opportunities. The first thing is search. Then select the most profitable opportunity. When you search, you may have brownfield project, greenfield project, new kinds of project, everything. You have to evaluate varieties of investment projects. And these investment projects, some of them you may get projects which meet your requirements, don't meet your requirements fully. Okay, some projects may be competing projects, some projects may be mutually exclusive, some projects can be implemented together. So whatever you learn in capital budgeting decisions, what you learned in CA inter capital budgeting, or what you're going to learn in advanced capital budgeting decisions in CA final, is basically about evaluation of these projects. How do you take project financing, how do you take project investment decisions, right? So you search for opportunities and select the best profitable opportunity. You search for the opportunity, and second SS, right? You select the best possible opportunity. Then you determine and make optimal mix of funds. So when you are investing in a project, what is the best mix of funds? Do you have to go for an equity issue, equity if it is a rights issue, or is it a QIP, or is it a preferential share issue, or is it a debt? If it is debt, is it what kind of debt? What long-term debt? Long-term debt, is it bond? Is it bank borrowing, or is it something else? We have to figure out varieties of things. What is the right or optimal capital structure mix, or optimal mix of funds? How much of equity, how much of debt? Within equity, what types? Within debt, what types? So things like that. All of this you need to determine, and then establish and use system of internal controls. That is, you are going to, once you make the investment, you have to set up controls for the project, whether the money is being rightfully, correctly and gainfully deployed. Is it meeting the budget, or is it exceeding the budget? Is it in line with what is required, or are we doing something that is not required? Are there enough buffers? Okay, you have to evaluate things all of like this to see whether the controls are in place. Then once that are in place, you analyze the results for future decision making. SSMCA, mix, controls and analyze. And what do you mean by analyze? You take feedback. Oh, we implemented this project, this happened in this way. From this project, what is the learning that this kind of projects, let's say you are implementing a project in Gujarat projects probably get over very fast, or probably in Gujarat there may be some issue with water, or you are implementing a project in Madhya Pradesh where probably there is an issue with forest clearances. So you understand deeply at ground level what happens to each project, and you implement those decisions. And you will think that initially project will happen in 3 months or 1 year. No, but you have to always assume that they happen in 2 years. Okay, all these ground level feedback you will take, and you will see whether you are meeting initial objectives of making the, or you will meeting the initial specifications that you set out in the initial plan, whether you're meeting them, not meeting them, and use them for future project investment decisions. So you analyze the results for future decision making purposes. So the focus is on allocating limited funds between alternative users. That is what I was telling you. So there are very, very scarce funds, every organization, right? How will you use these funds? What kind of decisions will you make? You will invest in project A or project B or C or A and B or A and C, what? Right, given the resources that you have. Then, what are the key decisions in financial strategy? By the way, this was a question that was asked in November 24. What are the key decisions in financial strategy? You have financing decision, you have investment decision, you have dividend decision, and you have portfolio decision. Financing decision is what is the mode of financing, whether it is debt or equity. In debt, long term, what mode, whether it is bank loan or whether it is bonds, or what do you do? Equity, do you do a rights issue, QIP? If you do a dilution, what is the impact of dilution? What is the optimal capital structure? What is the target capital structure? What is the capital structure of competitors? What is the what will this be seen positively or negatively by my existing shareholders? All of that you have to evaluate. Then investing decisions, that is funding long-term projects. That when you take a decision in financial, as part of financial strategy, the decision on investment, we just now discussed. Funding long-term projects, that is what project should I fund, what should I evaluate, which project should I take, which project should I reject, then when and how much to invest. That is a key decision that you make in this. Right, then you have dividend decisions. That is, dividend decision is once I generate certain profits, how much of profit should I keep with myself and reinvest in the business? When I'm generating returns from the business, are the returns better, or am I better off giving off the money as dividend to the shareholders? You will learn about a concept called sustainable growth rate as you move forward. Figure out whether the paying dividend is better or retaining the money for reinvestment within the business is better. And how do you arrive at that? You probably take decisions on what is the growth rate that you want, what is the cost of capital that you have, what is the cost of raising fresh capital, what is the return that you will generate on this capital if you were to redeploy. You look at all those and then take dividend decisions. Then you have portfolio decisions, that is evaluation of all investments using an overall portfolio approach. That is, if we will learn this in the portfolio management chapter, where you evaluate everything from a portfolio perspective. As an organization, does this make sense for me? I will not look at projects independently. I will not say this project is generating money or losing money. In the overall context, even if this project is losing money here, it is reducing substantial risk for me, or it is some other project is gaining huge profits because this project is losing money. Okay, if this project I shut down, the project which is making a lot of money, that project will turn into a loss making project. So you have to evaluate everything together from a portfolio based approach. Don't ever look everything in silo. Silo means individual. You see cement silo, they have huge places where this, or grain silos where they store grain or store cement. Right? You don't think in a closed manner, you think in an open manner. You look at everything in an overall portfolio basis. So these are key decisions in financial strategy. Right? Now, how is strategy implemented at various levels? Strategy is implemented at 3 levels. There are 3 levels of strategy. One is called corporate level. Corporate means board, senior management, and the focus is on long term. That is, focus of senior management is strategic. That is, what is the long term vision of the company, how much should I invest, what all projects should I invest, what kind of new projects should I go in, greenfield or brownfield, should we acquire this company, should we divest a business. Those are basically strategic decisions from a long term perspective. These decisions, they answer 3 fundamental questions: suitability, feasibility, and acceptability. That is, whether the strategy would work for accomplishment of common objective of the company. That is this strategy, whatever we are doing, okay, they look at everything from a long-term corporate heavy, 20,000 feet level. Would this work for accomplishment of common objectives of the company? Then it determines feasibility. Feasibility determines the kind and number of resources required to formulate and implement the strategy. I have told that there is a strategy. Do I have money? Where is the money for implementing this strategy? Do we have enough resources? Right? Not only is it suitable for us, not only is it logically we have to undertake this, but do I have the money to undertake this? And then acceptability. That is, it is concerned the stakeholder satisfaction can be financial and non-financial. That is, if I were to implement a strategy like this, will my stakeholders, when I say stakeholders, I'm not only referring to shareholders plus customers plus employees plus your vendors, everybody, society at large, will this meet the requirements of everybody, or whether anybody will have a concern. So I'll give you an example. Let's say I am a very wild example. I am ITC Limited. I'm already in the cigarette business. So a lot of people don't think it's a good business. Now suddenly tomorrow I say that I also get into nuclear power. Very random, right? Nuclear power. Do you think we have the resources? Do you think we have the time? Do you think we have the money? Maybe, may not be. Do you think we have the expertise? Maybe, may not be. But do you think what will my shareholders think? What will the government think? What will the society think? Those are also important considerations. So all these 3, corporate strategy has to necessarily answer these 3 questions on suitability, feasibility, and acceptability, right? Then you come to business level strategies. Again, business level is the second level. It is a mid-manager or managerial level, or at the SBU level. SBU means strategic business unit. What you learned in CA, Inter, SBU, right? It is intermediate term. The term is also short. They probably focus on 1 year, 2 years, whereas corporate level strategy is 3 years, 5 years. Whereas business level strategy is 1 year, 2 years, or probably sometimes even as small as a quarter also. And the focus is on the middle management. It is more tactical. Tactical means you are trying to achieve the near term objectives, not today's objectives, but you are trying to achieve the objectives for a month or a quarter or a year. Right? And what is the focus of this BU level strategy? The focus is on practical coordination of operating units. That is, you are trying to implement the strategy what the board has laid out for you. You are trying to ensure that the functional units, like your plants or your sales team or your marketing team, think of the role of a CFO and a CEO. They also are engaged with the board. Okay, CEO is part of the board, CFO may or may not be. Okay, but they are the ones who carry forward the the strategic vision of the board, along with the rest of the SBU heads, the CEO and CFO carry forward the strategic vision of the board to the functional units. They will tell them, this is what we want to achieve, this is what we want to be, this is what we have to go, this is what has to happen. Right? They supervise the operations in the unit, and they meet deadlines and targets set by the corporate level in developing and sustaining products and services. So the board sets the targets, the business or the SBUs meet the targets. And then you have functional level strategy, that is short term, that is basic, your plant. In plant, machine is broken down, do something. You have to, employee is not, there is some labor issue, get new people. Employees are not there, get them. There is some other marketing, there is a trucks have not come, or logistics, trucks have not come, marketing, new kind of marketing. All of that is the focus of line management, and it is very, very operational. It is bottommost. And the function of what is the focus of the functional level strategy? Which is for execution of BU level strategies on floor. That is, whatever your middle management tells you, or the CEO, CFO, business heads units tell you, you have to implement that. The functional units provide input to business unit level and corporate level on customer responses or on resources and capabilities. That is, plant will say, sir, you want to achieve 1,000 crore revenue, but we don't have capacity. Our plant doesn't have capacity. Or we have produced a new product, but the customer is saying the product is not good. Your marketing and sales team will come back and say that the product is not good. The customer wants something different. Or you will say that this particular kind of a new plant will require this kind of clearances. Please go and do all of those. So they will have feedback from the market, from the other stakeholders, and they will pass it on to the SBU level and the corporate level. And higher level strategies can be based on these inputs. So it doesn't, the corporate strategies cannot operate in isolation. मैं बोल दिया, okay, I want 1,000 crores next year. How will 1,000 crores happen? You have to also figure out that whether the SBU heads, the operating people, everybody is fully scaled up, aware, they have the capabilities, they know what is going on, you take market feedback. So all of this, the higher level strategies have to necessarily take inputs that come ground up. Okay, so from here, the inputs have to go here to here. Without that, no strategy will succeed. Okay, so the next point is, or the next topic in this chapter is financial planning and its three major components. So financial planning consists of three things. First one is maximize scarce financial resources using financial tools for decision making and to achieve financial goals. So resources using tools to achieve goals. So you use the resources using certain tools to achieve your goals. So this is called financial planning from a corporate perspective. From an individual perspective, it may be different. What is the salary that I have? How much years can I work? What is the expenses that I have for my children or marriage or vacations and all of that? And how will I, where will I invest in all of that? From a corporate perspective also, you have limited resources that you have to use various financial tools, right, to achieve those goals. That is, what all the tools like, you'll raise money, invest money, that investment, what kind of investment, all of that, right, you'll use that to achieve your financial goals. These are three major components of financial planning. Now, what are the outcomes of this financial planning? If you look at outcomes of financial planning, you have financial objectives, financial decision making, and financial measures. You have three things. Financial objectives, these are to be decided at the very outset so that the rest of the decisions can be taken accordingly. That is, I wish to grow by 10% every year for next 5 years. Very simple, okay, I'm giving simple statements. Or, I wish to grow at twice the GDP growth rate for the next 5 years. Things like that. These are financial objectives that are set for an organization. They need to be consistent with the corporate mission and corporate objectives. So, this needs to be consistent, okay, with your corporate objectives. So, you cannot say, as a corporate, my goal is probably to manage risk, okay, to ensure that we meet government objectives. So when you have such kind of things, you can't have this 8% growth, 10% growth. So your objectives and your goals have to be aligned. That is, your corporate objectives and your financial objectives have to be necessarily aligned. Then you have financial decision making. That is, it helps in analyzing financial problems that are being faced by the corporate and accordingly deciding the course of action to be taken. Right? That is, you take you take decisions based on financial metrics. That is, what are the financial problems that you are having, whether you have, are you facing shortage of funds, or are you having working capital issues, all of those. You consider all of those and then you decide on the course of action. This is a very important element of financial planning. And financial measures. What are the financial measures? How do you arrive at, how do you make these decisions? You use ratio analysis, cash flow analysis to evaluate the performance of a company. In addition, of course, to PAT and all of that, you also use a lot of these ratios and cash flows. Selection of measures again depends upon the corporate objective. So, what are the unique measures that you will use to evaluate your own performance depends on your corporate objectives, right? So, you can't have random measures. Okay, your corporate objective is to grow your market cap by 10x. Okay. You cannot use ratios that are not linked to this market cap. You have to use ratios that are financial in nature, that have linkage or that somehow directly or indirectly affect this market cap, right? So these are three aspects, or rather three outcomes of financial planning. Now, once you have done this entire financial planning exercise, right, there is something called as financial policy and strategic management. That is, the financial policy is how you are going to raise funds, and strategic management is basically how you deploy those funds, how you make investments. These two interact. Where do they interact? So fund mobilization is essential to support expansion activity of a firm. It is very vital for an organization. That's what I said. Financial policy mainly deals with sourcing of funds. Exactly, I've been telling right from the beginning. Corporate strategy deals with deployment of funds. Financial strategy is more about how do you raise. Right. Financial policy should be framed at corporate stage planning itself and not later. That is, you cannot say that I will grow 20x in terms of my revenue and not look at financial requirements or consequences of that. You have to necessarily think of them, both of them together and at the same time. They both cannot be independent with each other. So if you look at this, investment decisions, financing decisions and dividend decisions are key elements of interface between financial policy and strategic management. So what do you invest? Where do you invest? How do you invest? Then how do you raise money for that? Out of the profits, what do you do? Do you reinvest or you pay dividend? These three are key elements of the interface. So what do? You invest money. Okay, from the money that you invest, that you evaluate various projects, make the investments in them, and then you make money. That is, you generate some gains. Whatever money that you have generated, is it just PAT or is it cash flow also, right? That money you have generated, you have safeguard. That is, you keep it, you ensure that you don't spend it frivolously on some fancy projects. You probably evaluate and carefully spend that money. Then you decide whether you reinvest or distribute. That is, you give it off to the shareholders back because you don't have any great projects, or you have some phenomenal projects for which you want to reinvest. And if that is not possible, that is, if you want to invest in new projects and you don't have money, you again raise money. So this is a continuous cycle. That is, you raise, you invest, you make money, you safeguard the money, and then you reinvest or distribute the money. This is a constant cycle that organizations go through, right? This is what broadly is the interface of financial policy and strategic management. Now, if we were to look at each of these independently, right, in investing decisions, financing decisions, dividend decisions, we have dealt them with some depth, but now I'm going to go into slightly greater depth. So if you look at financing decisions, what are the things that you evaluate? What is the cost of raising capital? That is, at what cost should I raise? Which is cheaper, debt, equity? If debt is cheaper, can I take debt? Do I have covenants? Am I following the requirements of my other lenders? Do I have to take their permission? Do I take long term? Do I take short term? What is the cost? Then with each kind of financing, what is the risk associated? If I raise too much equity, there will be dilution. If I raise too much debt, there is greater risk. If I take too much debt, in fact, my other debt holders may not allow. Can I issue preference shares? So you have to evaluate all the risk associated with each kind of source of fund. Then what is the cash flow condition? Do you have sufficient cash flows to service those funds that you have raised? If it is debt, do you have sufficient cash flows to repay the debt, or in fact make the interest payments? Do you have sufficient cash flows? Are you generating enough profit to satisfy your shareholders? And then you also have control considerations. That is, whether the money is being deployed gainfully, rightfully, and in the proper manner or not. Right? These are financing decisions. Now, if you look at investment decisions, you look at either new project or expand. New project is greenfield. Expand is brownfield or cost reduction. That is, every kind of project that you invest will fall into these three categories. It cannot be outside these three. You are investing money either to grow your existing plant, put up a new plant, or reduce your cost. Okay. So allocation of firm's scarce resources in one of these based on capital budgeting exercise. That is, you do on one of these. Right. Project evaluation, project selection are two most important aspects in fund allocation. So when you are making investments, you have to evaluate various projects and then you have to select the right project. This is a very, very important thing. The focus on investment of a firm's funds into different assets to earn highest possible return and fulfill stakeholders' expectations. This is the goal of your investment decisions. Right. Then we discuss about dividend decisions. That is, firms decide how much they will pay out to shareholders in the form of dividends. They will choose. There are varieties of dividend policy. There are various types of dividend policy. You will have a variable dividend, fixed dividend, or mixed dividend. What is variable dividend? Every year, I pay 10% of my profit as dividend. So as profit changes, dividend changes. Okay, that is one way. Then you have fixed amount. Last year I paid 100 crores as dividend. This year I'll pay 110 crores. Next year 120 crores. Or last year I paid on an EPS of 10 rupees, I paid 7 rupees. This year I have to pay 8 rupees. I don't know what the EPS is, but I have to keep either my dividend per share as stagnant or increasing. That is called fixed dividend, where you keep it fixed, right? Then you have fixed and variable dividend. That is, some element is fixed and some element, depending on profitability, I will pay more or less. So you take these kind of dividend policy decisions where focusing not only on what are the various other investment opportunities, but also satisfying the existing shareholders who want dividends, right? So it involves choosing between investment in businesses versus payout to shareholders in companies. So companies also explore cash as well as stock dividends too. So a lot of companies explore stock dividends also. That is some kind of a bonus. And sometimes, in fact, you also explore special dividends like 50th golden jubilee dividend or super normal profit dividend. You also explore things like that. So if you look at this, all functional policies are interlinked with financial policy and they should be designed along with corporate strategy. and not in isolation. Financial policy and corporate strategy are interdependent and affect each other and are affected by each other. So financial policy and corporate strategy both are affected by each other and affect each other. So they have to be thought of together and not independently. Now, what are the elements? So we discussed about all three in broad level. Here we said that there are these three. So here we discussed about this investment, financing and dividend. Then we went into depth of each with respect to capital structure and the way you determine capital structure. There are 4 things that matter. What is a region? Geographical region, developed or underdeveloped. That determines what kind of capital structure you have. So if it is an underdeveloped country, very unlikely you will get debt. Probably you have to raise equity, right? Industry, what kind of industry? If it is a capital intensive industry like let's say steel or iron or power, so you take a lot of debt. What kind of sector? That is public sector, typically the debt equity ratio is ideally 1:1. If it is private sector, probably 2:1 may be better off, right? Then maturity, that is what stage is the business life cycle, that is are you a fully mature stage, in case you have stable cash flows you can take more debt, or is it an early stage where you cannot take debt? So you evaluate things like this as well. Now we come to this aspect called sustainable growth rate. What is sustainable growth rate? Sustainable growth rate is the rate at which the organization can grow on its own without taking any additional capital, right? So it is the maximum sales growth achievable by a company given its profitability, asset utilization and dividend payout with no additional borrowings. So without any additional borrowings, how much can an organization grow given its current status? By plowing back, PLOUGH, plowing back means putting the money back, its existing funds that it is generating. So it is computed as return on equity, that is ROE into retention ratio. Okay, retention ratio. What is retention ratio? Out of EPS, how much are you paying out as dividend? So 1 minus payout ratio is equal to retention ratio. So that retention ratio into ROE is your sustainable growth rate. This is the rate at which your sales will ideally grow. Okay. Now what are the assumptions under this sustainable growth rate? So if you look at, as you move forward to the other chapters where you look at security valuation, you will note of this term called G, growth rate. G is equal to B into R. B is your retention rate. R is your ROE. Okay, so you'll learn about this formula as you move forward. What are the assumptions underlying? Target capital structure is maintained. Obviously, you don't keep changing the capital structure, because if you change the capital structure, your cash flows will change, your PAT will change, quite a few things will change. So you will maintain a specific you will maintain a specific capital structure. Defined dividend payout policy and dividend payment ratio fixed and maintained. That is, you will have a fixed payment ratio. You will say, I will make certain amount of dividend payments every year, or certain kind of dividend payments. That is, I will not have fully variable, that is every year. See, please note here we are not saying fixed pay dividend policy. We are saying variable dividend policy where the variable rate does not change. So you consistently pay 70% of your profits as dividend. Okay, it is a variable policy only, but the variable rate is fixed. Okay, then no fresh equity is raised. Obviously, no borrowings are there. No change in capital structure, so no fresh equity. So these are the 3 assumptions underlying an SGR, sustainable growth rate. So sales can go faster if a firm issues additional debt or equity, else SGR is the maximum growth rate. So the growth rate at which it can grow, an organization grow without any additional fund infusion, is SGR. If you have fund infusion of equity and debt, probably it can go faster. When I say grow faster, I am referring to in sales terms. Okay, now what makes an organization financially sustainable? We have heard of this number called sustainable growth rate. From a financing perspective, what makes an organization financially sustainable? Or how do you balance financial goals versus sustainable growth? Basically, both of them mean the same thing. Please note, these are all important questions. Multiple sources of income. You should have multiple sources. An organization should have multiple sources of income, multiple channels of generating income. Not only sources, multiple channels, B2B, B2C. Sources means you have product A, product B. And within product A, product B, product A is B2B, B2C, things like that. Consistent strategic and financial planning, that you should always continuously plan and see what is happening, what is the strategy. You should always have a strategy and a plan backing that strategy, right? Then you should have stable financial systems within the organization. That is, you cannot have a scenario where the company is defaulting on debt and you expect some great sales growth. Okay, that doesn't work. The financing system should be stable, it should be stabilized. Then you have a good public image, that is, the company has a good standing in public. The organization has great clarity of values. The organization is known for its values and ethics, and there is financial autonomy. That is, you are able to take independent decisions with respect to finance as per what you want with respect to the conditions that you are facing. These are what makes an organization financially sustainable. Now, please note there is one more question which is very similar to this. We will come to that in probably a slide or two. Okay, please note the subtle differences there. Okay. Continuing on this sustainable growth rate policy, you can have three kinds of sustainable growth policy: very weak, weak or strong. In a very weak policy, there is no reduction in asset structure. That is, you are not selling off any assets, you are just maintaining your business and you are growing, that's all. You are maintaining assets and growing. That is very weak. Weak is you are somehow sustaining critical functions. That is, you are sustaining critical functions over a long period of time. See, no reduction in asset structure. Very weak is for short tenure. Okay, for immediate few months or years, you are able to sustain without any reduction in capital base. Whereas weak is you are able to maintain your capital base and you are also able to sustain critical functions, critical marketing, everything is operating as normal over a period of time for, let's say, 3 years, 4 years. Whereas a strong sustainable growth is one where you grow and thrive along with dynamic ecosystem. That is, you are growing both capital base, your functions are growing, your teams are growing, you are able to grow your sales and everything. So, very weak kind of sustainability, weak sustainability and strong sustainability. These are things that an organization, these are probably the phases or probably the choices that an organization faces, right? If an organization is growing at less than sustainable growth rate, that is, if I invest my money in, let's say, a new project, my sales are growing by 5% or 10%, okay? But my ROE into retention ratio, I should ideally grow at 15%. But I am growing at, my sales are growing at less than that. So, if that is the case, better to return the money through dividends or buyback. That is, you return the money. What will happen if you return the money? Your capital equity will come down. If your equity will come down, that is one way, right? Because when you return the money, your total equity based net worth will come down, or when you do a buyback, you will buy back the share, so equity value anyway will come down. When you return such kind of money, you have very little to reinvest, right? You have very little to invest. So, when that happens, the SGR will also come down. So, SGR is what? Linkage of retention rate into your ROE. So, even though ROE may go up, the retention rate substantially falls. The retention rate falls, very little money is left, then the growth will not be more. So, you will somehow, your sustainable growth also will fall down. So, you are growing at a pace that is better than your or equal to your SGR. Or you acquire companies to grow. If you are not able to grow at SGR, please go and acquire companies that will give you that additional growth, right? Then you have something called as, high inflation leads to high external financing and high debt equity ratio. That is, if prices are constantly increasing, then your working capital needs also increase. And when your working capital needs increase, you have to necessarily raise money. If you're not getting equity money, you have to raise short-term debt. And when you raise this short-term debt, debt equity ratio goes up. Please note one very important thing, ICAA has not done it clearly. Debt equity ratio is not just long-term debt, it is both short-term debt as well as long-term debt. Always compute total debt equity ratio and long-term debt equity ratio. Don't ever compute just long-term debt equity ratio. Always compute both of them. From a real world perspective, both are very important. Total debt equity and long-term debt equity. Right. So, if the higher the external financing, you have higher will be your debt equity ratio. You may fall foul of some covenants. Right. What is a covenant? We will discuss in one of the upcoming chapters. Right. If creditors require that a firm's historical cost constant DE ratio, inflation lowers the SGR. So, what it means is, debt equity ratio based on historical cost. What do I mean by historical cost? Basically, the amount of debt that you are raising versus the equity that you have, right? Debt is also book value, equity is also book value. None of them are market values. If they are not market values, what happens? As your debt keeps increasing, the debt equity ratio increases. Why is debt increasing? Because there is inflation, and for funding that high cost of goods, you have to necessarily borrow money or you have to raise equity. Typically, people resort to borrowing. When you borrow more, your debt equity ratio increases. When such kind of debt equity ratio consistently increases because of inflation, your SGR falls down. Why does SGR fall down? Because if you have to maintain a debt equity ratio, because creditors are saying the debt equity ratio is increasing, but I want you to maintain this ratio. If you have to maintain a ratio, what will have to happen? Either you have to reduce the debt. If you have to reduce the debt, you will lead to reduction in working capital, which will lead to reduction in growth. or you have to raise more equity. If you're raising more equity, what will happen? Your base will increase. If your base is increasing, your ROE will fall. Equity base increases, then net worth by equity base, your ROE will fall. If ROE falls, your SGR falls. Right. So, if your criteria require that a firm's historical cost based debt equity ratio needs to be maintained during inflationary conditions, then it lowers your SGR. Right. Then if inflation is greater than SGR in a mature industry, that is the sustainable growth rate is 10%, inflation is 15%, then funds will be blocked in working capital. That is exactly what I explained just now. That is lower reinvestment, which leads to lower SGR. Most of the money will go into working capital and it leads to lower SGR. Right. To maintain a growth rate consistent with constraints over D ratio or current ratio, an organization may raise external financing, which may be debt or equity. Okay. In order to maintain a growth rate which is where there are certain constraints on debt equity, you will resort to external financing. We will see a problem on that. They have added something new from May 25 attempt. We will see that. But before that, let us finish this small part. There is a linkage between growth capability and growth strategy, and here we are referring to sustainable growth. Both these are interdependent. That is, long-term growth is impossible with just one and not the other. That is, you need a capability and strategy. Same thing what we have been discussing, funds and corporate strategy and financial policy. Financial policy, you have to raise money and then you have to deploy money. Growth capability depends on resources, assets available and employed, and management execution capacity. So, capability is basically resource based. Do you have the money? Do you have the talent? Whereas strategies depends on strategic direction, organization values and goals and policies. Whether there are right policies that are guiding the organization, what is the long-term strategy, what is the vision, mission, all those are also required. Okay. Then I told you here there is a question, what makes an organization financially sustainable? Here there is a question, what makes an organization sustainable? Unfortunately, ICA has given very similar sounding stuff with two different answers. Okay. What makes an organization sustainable? Clear strategic direction, obviously that is there. Scan environment and identify opportunities, that you look at various opportunities and choose them. Attract, manage and retain staff, have good quality staff. You have good quality administration and financial infrastructure. Effectiveness in utilizing these resources. Whatever resources you have, you should be able to utilize them, and you have community support. If you have all of these, that is when an organization will sustain. Now, when it comes to sustainable growth rate, I want to show you a problem. Okay, this is the same kind of problem which was there earlier in, I think, M&A chapter of business valuation. We covered it in business valuation. Now they have moved this particular topic to the first chapter, financial policy and corporate strategy. They have moved this particular question. What is it that they have moved? Please see on screen. This is what they have moved. And what is it that they are talking about? They are talking about the part here. To maintain a growth rate with constraints over debt equity ratio and or current ratio, an organization may raise external financing, which can be debt or equity. So, they are talking about external financing. How much external financing is required? For that, they have given a formula. Okay. Now, I have solved this problem earlier without using the formula. We will go and look at that solution. Okay. But by using this formula also, we will get a very similar solution. Let us see. What is this formula first of all? External financing required, that is total external financing that is required, is TA. What is TA? Total assets by sales into delta sales. What is delta sales? Into that is increase in sales minus what are the payables and liabilities? Payables and liabilities divided by the original sale value minus M. M is margin, PAT margin. PAT margin into your new sale number into 1 minus D. What is D? D is dividend. Okay, PAT margin into new sale, of that how much is dividend? Well, that is subtracted. That is basically, that is reinvestment into the company. So, for that equity is not required, but you require whatever is the total assets into increase in sales, right? So, basically you are looking at asset turnover ratio, and what you, from that you are subtracting the out of that whatever is the increase in assets, how much of it is funded by increase in liabilities. You are subtracting increase in liabilities from increase in assets. So, it requires, it will tell you how much money you have to raise. From that money, you are also subtracting whatever the money you are generating on your own, that is profit that is left out on new sales after paying out the dividend to existing shareholders. So, you subtract these three, you get the external financing that is required. It's a very simple formula. It appears complex, it is not. So, let us go and look at the problem for you to understand this very well. So, they have given this question in the study material, in the financial policy corporate strategy also, they have given the same question, but they have added a zero everywhere. Okay, I am not doing with zero, I am doing without the zero. Answer is same. And there is also one small trick which small point I had to highlight to you. Okay, let us see. The balance sheet of Mrs. Sundry Limited as on one period is as follows. Share capital is 300 and everything is in lakhs. So 300 lakhs, reserves is 200, long-term loan is 400, short-term loan is 300 and payables and provision is 200. So total of 1400. Fixed asset is 600, inventory is 500, receivables is 240, cash is 60, total is 1400. So balance sheet is tallying finally. Sales for the year was 600 lakhs. So sales was 600. Sales are expected to grow by 20% during the year. That is, they are growing by 20% the year. So how much will be 600 into 1.2, which is 720. The profit margin and dividend payout ratio are expected to be 4% and 50%. So margin and dividend payout ratio are 4% and 50%. That is, net profit is 4% of 720, dividend is 50% of whatever that 4% is. The company further desires that during the current year, sales to short-term loans and payables and provision should be in the ratio of 4:3. That is, short-term loans, sales is the numerator, short-term loans and payables and provision, there are 3 items in the denominator, is 4:3. The ratio of fixed asset to long-term loans should be 1.5. Fixed assets to long-term loans. Okay, please remember fixed asset to long-term loans. And debt equity should not exceed 1.5. Debt equity should be less than 1.5. Here debt equity is long-term debt or all debt. I would always say look at both. Okay, they are not clear, unfair. That is very unfair. You are required to determine amount of external financing requirement, amount to be raised from short-term, long-term and equity funds. Okay, now you see initially we said sales is 600. The growth is how much percent? Sales growth was what? 20%. So 720. Then what is growth, as I said, is 20%. Profit is how much? 720 on 720, 4%, which works to 28.8, which is 4%. Out of the 28.8, 14.4 you are paying off, 14.4 you are retaining, 50-50. So 14.4 is retained money. Okay. Then what is the next ratio that they said? They said sales to short sales divide, sales is numerator, which is 720, divided by denominator is what? Short-term loan plus payable plus provision. Now you see in this context, no, the whole thing that you have to understand is whenever sales grow, most of the working capital items grow in the similar proportion. Most of the working capital items, almost everything grows in similar proportion. That's an underlying assumption here. So what are the working capital items here? Your payables and provisions. Short-term loans, is it a working capital item? So current maturities do come under current liabilities, okay, but it is strictly not a working capital item. Short-term loan is part of debt, okay. So interest payable on short-term loan is a current liability, but short-term loan per se is not part of working capital. It may be classified in accounting as current liability because short-term loan is payable within 1 year. So what we do is first, sales by short-term loan plus provision is 4:3. So if sale is 720, those 3 put together should be 540, correct? If these 3 are 540, my opinion is short-term loan should not increase. But let us see what is happening. Your payables, what is payables and provision? Payable and provision is 200. Now this 200 and short-term loans put together is 540. What is it currently? It is currently 500. It is currently 500. Now already it is 500. It has to be 540. This includes 3 items: short-term loans, payables and provisions. And payables and provisions are 200. This 200 will grow by 20%, will become 240. So 240 plus 300 is 540. No? So short-term loans need not grow, right? Okay. That is why we are saying short-term loans don't directly come under this part when you are saying growth in working capital. Now, anyway, let us come back. They said fixed asset to long-term loan should be maintained at 1.5. And debt equity should be less than 1.5. Okay. Debt equity less than 1.5, but fixed asset to long-term loan 1.5. What is fixed asset? Currently, the fixed assets are how much? Fixed assets are 600. Now, fixed assets are 600. Typically, fixed assets also tend to grow in line with sales. So fixed assets also will become 720. Sales also will go to 720. So your fixed asset turnover ratio is 1:1. Have they mentioned that anywhere? No. But is it apparent here? Yes. Your sales was 600, fixed asset was 600. The fixed asset turnover ratio is 1:1. So you will maintain same 1:1 next year also. Okay. Now coming to fixed asset long-term loan. If you know fixed asset is going to be 720, then fixed asset to long-term loan should be 1.5. That is, fixed asset should be more, long-term should be less. By how much? Fixed asset should be 1.5 times of long-term loan. So 480 is your long-term loan. What is your current long-term loan? Current long-term loan is 400. 400 has grown by 20% to 480. What have they asked? What is it that they asked? You are required to determine external financing requirement. We have not even come to that aspect. We'll have to tabulate everything that we have put and then figure out how much is the money to be raised from long term, short term and equity. So you are first put a working capital statement where you are saying inventory 500 has grown to 600, 20%. Receivable 240 has grown to 288, which is 20%. Cash 60 has grown to 72, 20% increase. Gross working capital 800 to 960, 20%. Provision is 200 to 240. Provision and payable. Here what do we have? Payables and provisions 200. 200 has grown to 240. Again same 20%. So your net working capital has grown from 600 to 720, which is net working capital, your sales ratio of 1:1 is maintained. Okay, 1:1 is maintained. Now, what is the external financing required? If you have to, what is it? For what do you need external financing? You need money for fixed assets and working capital. Fixed assets, how much do you need? Your fixed assets have grown from what? 600 to 720. So you need 120 here. Working capital has grown from what? 600 to 720. You need 120 here. So you totally need 240. But you have generated profits and retained some profits. How much? 14.4. So 240 minus 14.4 is 225.6. This is the actual financing required. Okay, actual financing required. From this, we will split into short term, long term and equity. So what is long term loan increase? We have computed here already. It is 80. Where is it? 400 to 480. No, where was it? Yeah, 400 to 480, 80. And short term, I specifically said 0. Why did I said 0? Because the provisions only grew by 20% in line with working capital, because of which short term is a balancing figure which is 0. So 80 is from loans and balance is from equity. What is the total requirement? 225. From that you subtract 80, you get 145.6, which is the total money that you are required to raise in equity form. You could issue new shares. Okay. Then, so what is the revised balance sheet now? Short term loan is 300, long term loan is 480, total 780. Share capital is 300, reserves is 200 plus retained profit is 14.4 and fresh equity is 145.6, which is this number here. The total equity is 660 plus debt of 780 is what? 660 plus 780 is 1440. Okay, 1440 is your liability side of the balance sheet. What is asset side of the balance sheet? Asset side, you've already computed working capital of 720 and you have computed assets of 720, 1440. So 1440 total matches. Now here is the point that I want to highlight to you. What is the debt equity ratio? They said debt equity ratio should be less than 1.5. Now is it long term or total? I have taken it total. Okay, why? Because debt includes total debt. Include short term loans as part of total debt. So total debt is 480 of long term, 300 of short term is 780. Equity is 660. 780 by 660 is 1.18. If you look at the study material, they have not included this as 780. They have just said 480 by 660, which comes to how much? 48 by 66. 0.727. See, whether you take total debt or you take long-term debt, it is less than 1.5. That is fine. But I specifically think you should compute both these ratios if you are asked in exam, because we don't know. CA Institute suddenly the exam department realizes that this is also right. Okay, so please always compute. Even in real life, you have to compute both of them. Okay. Now this is one way. What is the second way? Second way is by using the formula they gave. What is the formula that they gave? I'll just read out the formula and write it here. External financing required is equal to total assets by sales into delta sales minus provisions by sales into delta sales minus PAT percentage into S1, that is new sales, into 1 minus dividend payout. Now, what are these things? And when we say delta sales here, it is absolute value. Please don't take it as percentage increase in sales. If it was percentage increase, they themselves would have given it as percentage. So please don't make that mistake. Total assets is 1400 by sales is 600. 1400 only, no? Balance sheet total, yes, 1400. And what are the payables? Payables are 200. 1400 by 600 into the increase in sales, which is 120 minus 200 by 600 into 120 minus 4% of 720 into 50%, which is 1400 minus 200 is 1200, 1200 by 600 is 2, 2 into 120 is 240 minus 720 into 4% by 2, which is 14.4. 14.4, that is 225.6 is the external financing required. Did we get the same number earlier? Yes, we got the same number. Now this 225.6, we need to split it as short-term loan, long-term loan and equity. So if you find out short-term and long-term, you will get the equity value. How do you find short-term and long-term? Short-term, you follow the same logic, that 4:3 ratio. How do you find long-term? You find out the fixed asset to long-term debt ratio. That is how you find out long-term. Balance is equity. Very simple. That's all. You follow the same process, but now here they have given a formula for it. That's all. Nothing else. So friends, this concludes the revision session on chapter 1, which is financial policy and corporate strategy. So please do like, share and subscribe our channel if you're not subscribed to our channel on YouTube, because we give a lot of updates out there. And please refer us to your friends, because we will be really helpful if you can reach a lot more people out there. Okay. Chalo, let's move to the next chapter. All the very best.